So, let's start over. What's up, everybody? Welcome to another edition of Zach's Live Trader. Here with you always, I am the bearded boy wonder, Dave Bartosiak. And today, my friends, I feel like a new man. Partly because I think a part of me died this weekend. I don't know what's going on in other parts of the country, but here in sunny South Florida, there is a stomach bug that's going around, and I caught every bit of it. It was honestly the worst day of my adult life as far as, physical sense of just terrible well-being. Just terrible. It was so bad. I can't even remember even having a hangover. Imagine the worst hangover on earth that you've ever had. It was way worse than that. It was just terrible. I thought I was dying. So that was my weekend. But the good news is that later on in the Sunday, once I started to get my wits about me a little bit, then I was able to dig into the markets a lot. And even last week, towards the end of last week, I had a few people emailing me, and I started knocking around some ideas. I think this retail thing this might be the quarter that it gets really bad. And because before, it was like we were just coming out here and slaying the stupid names, right? Like, let's go ahead and beat up JCPenney, and let's go ahead and beat up Sears, okay? And then, now what really was my tipping point was this Nordstrom thing. Because, not that I felt, I get stuff wrong, right? It happens. And it blows up in my face, and there's nothing like having egg on your face. It's one thing, to sit here, and I'm sure you guys are wrong, and you talk with friends, and then I'm very public with the assumptions that I make and the decisions that I make. Obviously, it's on these videos, and it's all over the place. So I can't hide from them. So I've learned to kind of own them. So I do something that, doesn't work right. I go back and I say, well, what the heck? What was my thought process heading into this? What did we do wrong? What are we missing? And I adapt. That's what we do. That's the beautiful part about this business is there's a trade every day. But this one really irked me. This gap in Nordstrom following the earnings, after it already gapped down so much, just didn't make sense. And I could see if the report came out and it was just absolute carnage. Now, Nordstrom's had its problems in the past, and I've made money shorting Nordstrom. And I've played these gaps down and done well. But the thing about this is it's just unrelenting. And now here, Nordstrom is below the March lows. Just going down to nothing. Not to nothing, but look, you're off 20% right now in Nordstrom. That's a huge chunk. And remember, Nordstrom's got two parts to it. You've got the fancy Nordstrom brand, and then you've got the rack, which is the cheaper kind of discount TJ Maxx, like an awesome TJ Maxx, but a TJ Maxx nonetheless. And so if both sides of those business are getting taken out to the woodshed, I don't know if there's anywhere to hide. So I'm saying this as a general part of my sort of Nordstrom thesis. My retail thesis rather. And I guess the other part is that you need to learn from your mistakes, okay? Don't fall on the sword. And that's the good part about using options to trade these bad boys. Because even in a short put situation, right? Pretty much the worst case we get in a short whatever situation, right, is like the 1783. So what I mean by that is we'll get like a 17-cent credit and we'll have 83 cents at risk. And that's typically like the worst case scenario that I lead us into for the most part. So then you have 17 divided by 83, you get a 20% chance to the upside, and you lose and you lose the rest of it, right? So now compare that to a situation where you go long 100 shares of Nordstrom that same day at 50, right? So 100 shares of Nordstrom right now you'd be off $10 on 100 shares. You'd be out $1,000. So that's why we use options to do these things, because these are high risk events. We all know that. And it actually helps to limit your risk. So when you're wrong, you're not wrong as much as you would have been if you just held 100 shares of the stock. Okay. So anyway, so now this has become more, today's show on Target is way more than just a show on Target. This is all about retail. And I almost wanted to tilt everything so that we were talking retail, because we do have Walmart coming up. But really, Walmart is probably just going to be follow through on this Target thing. Because I think, isn't Walmart the day after Target? Thought it was. Anyway, so this is what's all about retail, right? What's the retail ETF? Isn't it XLR or something like that? I'm going to figure this out. No. The retail ETF. Where's Eric Dutram when you need him? XRT. That's what it is. XRT. So this is a basket of all the retail stocks, and you can see how this is done. Basically, already near the lows. I mean, we're approaching the lows that, we really, we've seen them, but haven't gotten down below sort of these levels. This sort of 40 and a half, right? XRT, yeah, thanks, Dave. Below these levels we haven't gotten, right? I'm going to go out on a limb and say this quarter we get under these bad boys. I think this gets worse before it gets better. Okay. For a variety of macro reasons, I don't subscribe. You guys ever read Zero Hedge? Now, I am not the kind of guy that just reads one thing and like one doctrine and one school of thought. So like, I'll read liberal propaganda, I'll read conservative propaganda, I'll read everything in between, right? Because I just want to get perspective. So when I'm looking at these things, so I'll look at Zero Hedge just to get just to get the negative perspective. Because if you look at Zero Hedge, like we're all going to be, we should stock up on water and ammo and powdered meats like immediately, because we're going to be living in bunkers because World War III is going to break out. So I try not to get too, depressed about these things. They do offer up some perspective, and you get little fun stats and such. And really, the fact of the matter is, the foot traffic is down across malls in America. People are lazy, just ordering on Amazon without going out, and that's what's happening, right? And down here in Miami, my girlfriend works in retail, and so I get a lot of feedback from her friends of what's going on and what's working and what's not working, and there's a whole lot out there that's not working. So anyway, let's get back into this. Yes, Home Depot is doing all right. And you know what's not doing all right? Just got a Microsoft update and a Windows update, and they gave me, they updated the Internet Explorer. And now this gets to happen, right? So now this is going to be crashing on me throughout the course of the day. If you know me and my patience with bar chart, you know that I don't have any patience for this stuff. Look at this. Free stock chart's not working. Come on, free stock charts. Load it up again. All right. I wanted to take a look at this. So here is Target's revenue. I know we're going to get into the Zacks.com stuff, but I just want to touch on this real briefly before we start getting into stuff. So just revenue estimates here for Target, actual versus, yeah, want to cry. I got Windows 10, man. There's no want to cry here. I want to cry for other reasons, but it's got nothing to do with Windows. All right, so we've got negative 5.8% revenue growth last year, aiming for 1.18 this year, negative 1.18 that is, and then 14 bips to the upside next year. That's not really the important part I want to look at. I got some nice little charts. I got charts everywhere. I got charts coming out of my ears. Let me tell you. This is what I wanted to show. So we've actually got them in the sub-industry of retail, discount, and variety. I mean, the Zacks industries are kind of, I'm not going to say that the industries are screwy, but they don't, we have a lot more. We have 265 sub-industries that we rank, so it's significantly more than you're going to get from, you know, the S&P. We cut things up a lot more. Let's put it that way. So, and we've seen that Target here, this is going back a while, was this Q2 of 2014, tracked with the index, or with the industry rather, for a while. There's been some divergence here recently coming into the fourth quarter. So let's just look year to date. You see Target, huge underperformance from Target relative to the industry. So this has been leaking slowly, while the overall industry has actually been holding in there a little bit. So it's just interesting to see, get back to Target, all right, that these guys have just been beat up so much, kind of quarter in and quarter out already, right? I mean, just going back to November, really. Really nasty. And these gaps down, too. Gap never gets touched. Almost gets tested. Gap never got touched. Almost got tested, right? So here we are in another situation where we got close to the gap, and then Macy's happens. And then they just sell into that, right? And you could see from the money flow, got the gap down, money flows negative, stay negative. Turn up positive just in the last few weeks. Did we see that anywhere else? I want to see if we saw that pattern. Did we see that in Macy's? Didn't see it in Macy's. That pretty much stayed negative the whole time. But we did see it here. There was some positivity here in Nordstrom, right? There was a little bit of faith, and they just crushed the faith. I think maybe this here in Nordstrom was retail. Retail faith, retail buying. Could it be the same for Target? This is just a little bit of retail faith heading into the number? Perhaps. Okay. So the Target situation on the chart, not the greatest. Really this $60 level, 59.67, so we're just going to call it 60. Pretty firm cap, I think. And then you got support down, what, 52s? 52.85, 52.75. And you can see here on the histogram of the volume at price here, right? Big chunk of volume over here. I don't want. You got to be careful what you're drawing over here. Let's put a line. All right. So that kind of puts sort of where that recent sort of market point of control is, sort of around $56. That's where we've been wavering, sort of in between. So not a whole lot going on there. And the last major support shelf was up here near 70. And that gave way quite some time ago. Since then, lots of negativity here in Target. All right, let's get Zaxy with it. Look at the price consensus and EPS surprise chart, which usually I kick things off with, but today I figured I'd wait 18 minutes before we started talking about it. So, as always, the black line corresponds to the right y-axis, which is price. The little green arrows are earnings beats. Red arrows, earnings misses. If you notice here, a couple of misses, right? But even on the misses, had the stock price rise there. Of course, it didn't happen last time. The multicolored lines represent the evolution of our Zacks consensus estimates over time. And you'll see that there was a little bit of positivity here towards the end of 2014 for Target. And that positivity with the turnaround gave way to disappointment in 2016, and these numbers have dropped precipitously for Target. And if you notice, one thing I like to do on these charts is sort of just draw the line straight across. Of course, I'm crooked and I'm running into a keyboard here. That's fine. Don't judge me. So basically what, $4-ish? And then you can see sort of historically when's the last time estimates were there, right? And where was the stock last time estimates were down there, okay? So when you had sort of that front year, that low was here basically, right? Because this was the growth estimate, so you can't look at that one because that's the next year promise. Anyway, so with the stock around, 62, and then that came down, and it just got worse, right? So not the picture of consistency that you'd like to see when you're looking for a long-term stock, right? But some of you value guys out there might be going, hey, wait a minute, this thing is down here in 53s. I mean, these are multi-year lows. And they are. How far back can I go? I can go back pretty far. How far do you have to go back? You got to go back to 2012, the last time the Target shares traded this low. That's a long time ago. All right, so there's the price consensus EPS surprise chart. Let's take a look at what the analysts have to say. Zacks ranked number 3, hold, value style score of A, growth of A, momentum A, VGM composite score of A. They're going to be reporting before the market opens mañana. 13 times earnings right here. That's probably why they got the value of A. The industry is in the top 42% of our Zacks industry rank. We already looked briefly at the revenues, but this quarter specifically, negative 3.43%. Next quarter, negative 1.74. Current year, negative 1.18. Next year, 14 bips to the upside. If you look at the EPS numbers, this is where the ugliness is. Negative 30% EPS growth. Next quarter, negative 19. Current year, negative 20. But next year is going to be better. We're going to figure it out next year. But look we've actually got an analyst going out on a limb and increasing their estimate for the current quarter, current year, and next year within a week of their report. That's typically a good sign. But they didn't move much because if you look here at the actual magnitude of our Zacks consensus estimate, that increase didn't do a thing, right? And if you look at the current quarter numbers, they've still gone down from 131 down to 89 cents. Next quarter's gone from $1.31 to 99. Current year from 529 down to 399. Next year from 565 down to 4. In terms of surprises, they missed by a nickel last quarter. I don't think that they're going to miss twice in a row. I think they've got a nice low bar now, right? I mean, this bar dropped significantly. So they're hoping to just limbo in underneath there. But look at that. Now, we know that year to date, so more than 90 days, stock's off 24%. And their EPS estimate is probably in line with that, right? So everything's kind of setting up for this. Okay. As always, the good old bar chart. Let's start digging into some options chains. See what these guys have going on. 3 days till expiration. Switch this from the stack view to the side by side. Stock's trading 52, are you 52.50s? Yeah, 52.50s. All right. Let's go ahead and look at that. Or 54.50s. I used to be able to talk and like make sense. Remember, guys, I was under the influence of stomach flu and medicine all weekend, so I'm coming out of my haze. Even yesterday was a rough day to work. 54.50 call, 153 by 159. We're going to call that 156. The 54.50 put is 144 by 149. We're going to call that 147. At the money, looking at 303, so a $3 move. $3 ain't that much. Divided by the 54.50s. So they're expecting a 5.5% move here out of Target. 5.5%, $3 holler. What does that look like with what we've seen in the past? Pull up my handy dandy consolidated surprise sheet here. And you'll see the last 1, 2, 3, 4, 5 quarters have all exceeded that move. What about before then? So then we got 1 quarter didn't do anything, and then we've got a few. Then we got a few didn't do anything. All right. So it's just kind of this recent history has had a bunch of movement. And that's with EPS basically in line and just kind of missing by a nickel last time. The revenues last time, there was a small disappointment on the revenue side. So revenues are going to take the cake, I believe, here, which they often do. Because you could go ahead and massage that EPS as much as you want, but it's tough to massage the sales side of things, right? Okay. So, let's take a look here. Get our post-earnings drift on. So, let's do this. Since we've been in this sort of habit of doing these front week like credit spreads, right? And these things have been blowing up in my face, I'm not going to do it today. How about that? So I'm going to learn from my recent mistakes and allow the earnings analysis to actually be earnings analysis versus just on a whim analysis that Dave thinks he's smart and then I'm not and it blows up. So let's actually lean on the analysis that we're doing and give this thing some time for that post-earnings drift. Now, that being said, how many people experimented with a calendar spread like we were talking about on Home Depot? Just throwing it out there. I guess I'll put it in the chat. How many people did a calendar, a diagonal spread, whatever you guys want to call it, calendar spread on HD? Just wondering, right? Just wondering. Okay, so now we're back here on target. So we could use this 55 area, call or put as sort of our anchor because it's at 54, 54 and a half. Pretty much that'll be fine. Let's change from the side-by-side view to the stack view. This is all well and good too. And remember, so this isn't really going to be all that cute, I think, on target. On some really basics, the basics, okay? So if you're bullish target, you think it's going to move more than this $3, okay? But if we have, look at this. If you guys can hear, there's one of the wonderful benefits of living at the Intercoastal Yacht Club is that the management loves to do construction on the units, either above you, below you, next to you, and not tell you anything. And they just start going in and making all sorts of noise. So it's fantastic. So if you hear a very loud buzzing sound, it's because the management company hates me. Okay. So let's take a look at this. You know what? I don't blame any of you guys for not taking it. I don't blame you. I was just wondering. Okay, so let's go back to this, just like a call spread, right? A real simple call spread. I think if you are bullish here on target, and you're going to see that these rewards are, you know, the risk versus reward here is pretty nice, because the market's expecting it to move $3, right? So long the $55 call, in this case, is going to cost you $185. Simultaneously shorting the $57.50 call, you're going to get back 90 of those cents. So that's 95 cents, okay? That your net outlay is going to be. Now the difference in the strike prices here is $250 minus that 95 cents. That's $155 you can make on 95, or 163%. That's a lot of money to be made on a stock moving $2, $3, right? That's a ton of money for a stock to be made on a stock only moving that much, right? So that's pretty righteous. So I think what is this called? Bull debit is long the June 16th 55, 57, 50 call spread, 95 cent net debit, right? Boom. Now if we're bearish, and that was the thing, even on being bullish, I think you do have the potential for that thing to get all the way up to 60. So if you have some conviction, you know, but this is I would rather from here on out continue to be wrong being bearish on retail than continue to be wrong being bullish on retail. You know what I mean? Like, I just think overall there's going to be more bad news than good news here for retail early on, at least. I mean, somebody's got to have a good report, but the market, it's going to take a lot to move this market. Here's something that clues you in as to what the overall market is feeling now. And we were saying you could see Target all the way down to 50. And I think that is the case. I think Target gets worse. If it unwinds, it definitely unwinds. So what if you go along the 55 call here? It's going to be 221. Now, when you're looking here at this 52.50, I'm going to price both of these out for you too. So if you were to simultaneously short the 52.50, you're going to get back 113. So that's 108. So that means you're going to make 142. Come on, calculator. 142 on 108. So you can make 130% there, right? So that's pretty good. But what if you went the 55.50 put spread? Really got aggressive. Your net outlay is going to be 169 in this case, because it's still going to be 221 to go long the 55, but you're going to get back 52 cents on that $50 put. So that's 169. Now the amount of money you can make here, the difference in strike prices is $5 minus that 169 is 331 divided by the 169. So you can almost triple up on this trade. So 195%, right? Now, the interesting part about this is that, you know, the real difference here is what your break-even price is going to be on the two of these, right? So should you decide to go the 55, 52, 50, your break-even price is basically the amount of money that you paid for it. So your net debit, which is 108. So 55 minus that 108. So 53.92 is going to be your break-even on that. So shares of Target would have to close at or below 53.92 for you to break even on this trade. That doesn't sound so bad, does it? It sure doesn't. At least not heading into this thing. Now, on the flip side, should you decide to add more risk, because you are, and go with the 55.50, now 169 is going to be your net debit. So you're going to have to take that 50 minus that 169. okay, 55 rather, minus 169 is 53.31, okay? So a little difference in what your break even is, but not a drastic difference in what your break even is. And your upside potential is a lot more on the 55.50. And the carnage that we've seen here. Now here's the trap, right? This sort of value trap. Because you're looking at this and you're like, man, this is a stock that was $84 a year ago. And even just going back to November, we were near $80. Like, what has happened that now all of a sudden we're talking about Target, retesting lows and going lower and getting to multi-year lows? We know what happened. Amazon happened. Walmart happened. Continues to happen. It's this mix between the fight, rather, between the brick and mortar guys and the online guys, and the integration between the online guys and the brick and mortar guys, and all of this that's happening. And for, are these shopping destinations that you want to go to that are drawing you there, or is this like something that's kind of like a burden for you? And it's way easier just to be like, oh, heck, Amazon delivers it to my door all the time. Like, I don't need that, right? And then with Target, I guess we go to Target every once in a while, but just like we go to Walmart every once in a while. But more often than not, like, we're at CVS, right? But I guess, just for everyday kind of stuff. But if you're going to Target, getting, appliance, like your blender, your clothes, like, I don't even know what people go to Target for, to be honest with you. Versus like an Amazon, right? So maybe this is like a shift. I don't know. How many of you guys go to Target? Just throwing it out there. Just wondering. You know what? I need like polls. I need real-time polls being put up in these things so that we can have these live going while I'm asking these questions. Okay. So officially, guys, I'm going to say Bear Debit is long the June 16th 55.50 put spread for that 169 net debit, right? So I think you get aggressive to the downside, okay? Now, if you're looking to do a credit spread on either of these bad boys, you can use, you just go a little further out, right? So on the credits, I think it'd be safer on the call side really to get above 60, because that's that gap. Remember, there's that huge gap above at 60, right? So if you guys could go ahead and short that, I think we'll be okay. So the math on this isn't like fantastic. You're not going to be like screaming about this one. And then we'll look at the front week real quickly. I know I promised I wasn't going to look at it, but let's just look. So if you go short the $60 call, that's 43 cents. Simultaneously buying the 62.50 is 19, so that's 24. And then you're going to have 226 at risk. So 10% is what you can make on that, right? So that's not a lot. It's almost like if you believe in the drift lower, I guess you could get a little bit more aggressive, right? You could go the 62.50 or 60. Oh my goodness, 57.50. Remember, guys, medicine. I was taking some Tylenol PM, and it doesn't exactly help your brain. So if you go short the 57.50, again, this is you're allowing time for that post-earnings drift. So you think that Target's going to have a bearish report, and you're just like, you know what, I'm going to go out a little bit here and just go ahead and let this thing unwind. Selling the 57.50 call, you're going to get a 47-cent net credit here, because the 57.50 is going to be 90 cents, and then simultaneously long the 60 is 43 cents. Okay, So 47-cent net credit. The amount of money you're going to have at risk here is going to be 203. So you can make 23% on this. So I'm going to say the bear credit is short the June 16th, 57.50, 60 call spread for a 47-cent net credit, okay? All right. And the bull credit, right? Still got to do it. The bullish credit spread. And I think if you're a bull, again, you could say these 55s. If you're going to be a bull and you're going to put on a credit spread, you should be rewarded for it, okay? So this is going to be my bullish credit spread, because you need to be properly compensated for your risk if you're going to take this on. So going short the $55 put, you're going to get 221. Simultaneously going long the 52.50 put, you're going to give back. So basically the opposite of my other trade. Should we do that, or should we go further? What's the risk versus reward there? That's 108. Okay. No, I don't like that one. I'm changing my mind. Scoot down one more if you're going to be a bull. Just scoot down one more, because it doesn't look too bad. 113 is what you're going to get for selling the 52.50 call, simultaneously buying the put. Man, I'm terrible today. Simultaneously buying the 50 put, you're going to get $61 net credit. Okay? The amount of money you're going to have at risk is that 250 minus that 61, or 189. So 61 divided by 189, you can make 32%. So if you're really, if you think this thing's overcooked, you know this thing's overcooked, you really want to get compensated, I'm going to say the bull debit is short the June 16th, 52.50, 50 put spread for, what was the number? 69 cents? I already forgot. 61 cents. 61-cent net credit. Okay? So there's that. And so I think we just got to keep on piling on here. I think we got to be bearish on Target. We got to be bearish on everything until the world proves us otherwise. Basically, you just have to slay. Just have to get out here and slay everything. Everything that moves, shoot it. And see, this is a weekly chart here. Now if you look at the dailies, you can just see how this rolled over. So part of this, I think, right, you have kind of expectations bottomed, and then people started to go, nah, it's going to get better. And then now we realize it's not getting better. So this is probably going to challenge to the downside. So I think these lows come into play immediately, and then they even give up a little bit more. Target has been known to gap on earnings. So you're going to get another gap on earnings, I think. And I think the gap goes maybe even under 50, right? So that's what I'm talking about for Target. Lotto tickets, I know you want them. Look at the open interest on the $50 put. Right? Yeah, Norm, I like that too. Norm, I like simple put too. I like simple put too. So there we go, guys. And yeah, you could tweak it. Like I say, you guys can always feel free to move your goalposts a little bit. It's totally fine. Like, trust me, I'm not insulted at all. The point of this is just to kind of give you guys, some analysis on the stock and the underlying, and look at what we're seeing in the options chain, and help you out. That's all it is. I don't, if I give these picks to hold myself accountable and to give myself some sort of, idea of if I'm an idiot or not that week, right? That's what's up. So back to the situation here with Target. Yes, I think they are toast. What else are we talking about? Norm? Yes, go ahead and just buy a put if you want to. It's cheap, brother. Go ahead, rip it. That's totally fine. Target does have a tendency to gap, so you can mess around in this if you want to roll the dice a little bit. Lotto tickets, like I was saying, look at how many people have this $50 put. I think you could buy a lotto ticket anywhere in here. 52s, 51s, 50s, anywhere in here, okay? Anywhere in here. So I'm going to say lotto officially lotto May 19th 51 put. Not even, should I 51 or maybe the 5150? I'd say 5150s would, a couple of that would go. Let's say 5150 put for 39-cent net debit, right? Boom. That's my lotto. So there you go, gents. Mr. Wallace, I like AMD. But because of machine learning, some deep machine learning. This sounds dirty to say, right? Deep machine learning. So I know we're getting a little off topic here with AMD, but that's okay. One of the reasons why NVIDIA is killing it so much is because, people are using their GPUs in these algos that are like learning algos, machine learning, which is kind of like, remember the whole cryptocurrency thing? They used to use AMD chips a lot more in the early days of Bitcoin for Bitcoin mining and stuff like that. But I think there's plenty of space in there, and there's lots of demand, and that is going to help AMD also. But AMD, never underestimate the ability of AMD to screw something up. I know that sounds terrible, but look, they're second fiddle. They're always second fiddle. Why are they always second fiddle? Right? They're second fiddle to Intel for years. They're second fiddle to NVIDIA now. Why can't they get out of their own way? I just don't understand it. But that's like a 2-second quick little snap. Okay? All right. So I'm going to get some tea and honey because my voice is already roasted here. Dying here. Slay Urban. Slay Urban. Slay them all. I think we should all be looking for bearish opportunities in retail. Let's start picking them off. I want to hear success stories. Buckle is reporting, I think. I was tempted to get in there and slay Buckle and then go to a Buckle store and buy a bunch of stuff and then just return it immediately just to get their hopes up and then crush them. Anyway. All right, everybody. So thanks so much for hanging out with me here today on Target. And I will see you all mañana for whatever the heck it was I said I was going to talk about mañana. I already forgot. But what was it? Maybe I should look it up. What are we doing tomorrow? I can't remember, guys. It's on the list. I'll shoot out the emails very soon. So thank you very much, and enjoy the rest of your day. Have a good one.